Great. Mike is originally from the UK and is now based in Western Australia. He has almost 20 years as an investor in options trading as well as other financial instruments, and has been educating and coaching others to do likewise in excess of 7 years. Although he has experienced a range of different vehicles, his major focus both personally and in education settings has been in the context of options trading and psychology of trading, as well as development of his own programs of education, writing, and presenting. He has acted as a consultant for many other education and investment organizations, aiming to offer their clients a greater insight into the discipline, consistency, and knowledge that it takes to become a successful trader in a lifetime. His enjoyment and passion for teaching has made him a sought-after speaker, and he has regularly presented at conferences, workshops, and online events. Now, amongst others, he currently consults as options specialist for Hawkeye Traders. So it's my pleasure now to introduce you to Mike Smith from Hawkeye Options.
Fantastic. Thanks so much for the kind introduction. That's very generous of you. This is a labour of love for me. I just totally enjoy what I'm doing. As you've been told, I have been investing for in excess of 20 years with options, and that is my investment passion, and that married with the teaching is really why I'm here today. I do some consultancy work, but most of my time is spent on my 5 acres, about 45 minutes outside of Perth, Western Australia, with my 4 gorgeous children and delightful partner. And look, this is just such a pleasure and a privilege to be with you today, and I hope that every one of you, irrespective of experience, the experience you come in here with, walks away with something today. Now, just a couple of things which are important. I've got to put this up. It is important that we are talking a leverage vehicle, and as such, if you're not used to trading with leverage, then the rewards are exaggerated, as are the risks. And what is essential is that you understand this before you dive into the wonderful world of options, and it's the reason why risk management forms the major part of everything that we teach. So that's going to be a common theme throughout what I talk about today with you. The other thing that I want to say, which is important, is this is going to be content rich. I've got a lot of stuff to cover, and I am going to move quite quickly through it. I do recognize the different levels of experience on here, but I'm hoping that there's something for everyone, even if you're be it a new investor in options or something that you've been doing for some time now. So I am going to move quite quickly, so don't worry about making copious notes. I'm going to make the slides from the presentation available, along with a number of other things that are going to add to some of the things that I'm going to say. There isn't a sell from me tonight from this presentation. It's purely to give you as much information as I can, so you can walk away feeling as though you've got something to put into practice in your particular type of options investing. So the other thing is that often on these webinars there are many questions. I'll do my best to get through them all. If I don't, I promise to follow up anybody personally and answer them after the event. So all that being clear, let's get into the nitty-gritty in terms of what we're going to cover today. And I did say it would be content rich. So we're looking at one of the first things that's really important is why the win-loss ratio, which seems to be the focus of many new investors and investors generally, is probably not the best measure to determine whether you're going to be successful in the long term or not. I'm going to show you an example of why that's not the case. There's 2 essential components of your trading plan that really most people don't have in place, and having been an educator and coach for around about 9 years now, these are the sorts of things that I'm talking about today that crop up again and again and again, irrespective of experience. I'm going to talk position size with options because it is slightly different to position size in equities or FX or futures or whatever other vehicles you're trading. There are a couple of interesting idiosyncrasies that you need to know about, and there's a position size calculator I'm going to give you access to as well. I'm going to talk very briefly about exits because exits is what it's all about. And one little trick for those of you who are experienced is how to accumulate into a profitable options position, i.e. buy more of it so you can profit more. And then 5 mistakes that experienced and new investors make as they go along their options journey, which usually mean they contribute to the market or contribute to other people in the market rather than into their own account. So that's really what I'm going to cover in the next 40 minutes or so. So let's crack on really. So let's look at this win-loss ratio as a start. And really what this does is it measures how often the trade goes in your particular direction. Now, in terms of the importance of that, it doesn't measure the degree of those wins or losses. It's not congruent with the underpinning concept, which you've all heard, of keeping your losses small and letting your profits run. There's nothing there about how many times your trade goes your way and how many times a trade doesn't in that particular statement. Its relationship to overall trading success is directional trading, i.e. buying calls and buying puts, which you heard from very capably from the last speaker, is relatively limited. For other strategies it's more important, but we are focusing on directional options trading for this particular presentation. So it's by far and away not the most important metric, but it's still worth measuring as part of your overall battery of measuring. As you know, any good business, and I'm sure you're hoping to treat your trading like a business, is based on good systems and testing and measuring them. So if it's not win-loss ratio, what is it? Well, here is the last 55 trades. These have been transparent, sorry, the 55 trades between end of September and end of May. So these gave a percentage loss. These are each trade a percentage loss or gain over the 8 months in that period. So the overall result in this particular portfolio, which was transparent and part of the trade alert service that we offered, is around about 252% for 8 months. So bear in mind that it was a good market, etc., etc., but nevertheless, it's still got to be managed well. Now, there are a few things that I want to point out here. First of all, obviously, it's 55 trades over 8 months. That gives you an indication. Oops, that gives you an indication about how often trades are placed. The average length in a trade was 9 days, although the range was 2 to 23. Here's the key factor, and you'll notice this. You'll see it on the graph. You'll notice that those green bars are significantly higher than the red bars. And that is the profile of a successful portfolio, the anatomy of a good trading portfolio, if you like. You'll notice that there are at times there was a time where there was five losses on the spin, 4 losses here on the spin. And in fact, the win-loss ratio with this was 28 wins to 27 losses. So it was around about 50% win-loss ratio. So how on earth did it make 252%? The answer is simple. It's this fact here. These two figures here are what it's all about. The winning trades, those 28 winning trades, had an average percentage gain of 65.54%. The losing trades had an average loss of 22.47%. And remember, we are talking leveraged instruments, so this is not an unusual ratio for wins and losses, providing you manage it well. So what we've got, it's time to get to that next slide, isn't it? So what we've got is a situation where we've got a reward to risk results ratio of 3 to 1. Okay, so for what that means is we can have 3 losing trades to 1 winning trade and still be in a break-even position. So in terms of a win-loss ratio, we only need to have a 30% win to loss, and we're going to make money. Sorry, 33 if we want to be exact. That's the power of starting to measure this. And you'll see how this is congruent with that idea of keeping your losses small and letting your profits run. Okay. So this is the key metric to measure. Look at when you have a winning trade, what the average percent is, and when you have a losing trade, what the average drawdown is. That's on the specific trade, not on your account. That's, in directional trading, that's the key thing to measure. So if you're not measuring that, get measuring it. Okay, and if you're not getting that, these figures which have a greater winning percentage than a losing percentage, then you're not adhering to the idea of keeping your losses small and letting your profits run. Now there's all sorts of things we can put in place to contribute to this, and some of them we're going to talk about now. There are two rules I said that most people haven't got in their trading plan. This is one of the contributing factors. One's market related and one's person related. With the market related one, what we're going to do is we're going to use the index, the S&P 500, the VIX and volume to determine which direction we should trade and whether we should adhere to our existing position sizing model or reduce it. The two aims of this are not only to assist in that decision making, inform us which direction to trade and why we shouldn't be trading against the overall trend and against the VIX and when volume doesn't suit us, but also as option traders, and those of you who have been trading directional options for a while will know this is the case. The most dangerous time is a quick market turn upwards or downwards, because irrespective of whether you're long or short, what tends to happen is you tend to accumulate 3 or 4 positions, whichever is your maximum number of positions open, and then the market will turn, and all of a sudden you're left with 4 positions, all of which are losing because the overall market has changed, or vice versa if you've got 3 or 4 puts in place. So this is designed to reduce the capital damage of that by being a little more proactive in terms of entry, and there's also an exit for you. Now, as part of the O kit, and write options kit down. I want you to write options kit down because that's going to be important later. I'm going to give you the detail of this, okay? And as one of the downloads you're going to get for free. But this, briefly, is what it's all about. So we look, if the SPY is in a downtrend on the weekly, or the VIX is green on the daily with the SPY not in an uptrend, we don't trade calls, and vice versa with puts. And what we've got is we've got a little algorithm here that tells us what we should be looking at in terms of a daily trend, weekly trend on the S&P 500. 2 situations where we'd bring in the VIX, what the volume is in terms of the direction. Is it buying, is it neutral, is it selling, and whether we're talking about calls or puts, and our action. So if we've got a daily, if we've got an uptrend on the daily chart, on the S&P 500, and on the weekly chart, daily volume doesn't matter. We can have our normal number of positions open, which for me is no more than 5, and we can position size as we normally would. We're going to talk position sizing in a moment. If, however, the weekly trend is in neutral, then we would have our normal positions but reduce our position sizing. If our daily trend is in neutral or down, but the weekly trend is still up, we can still enter calls, but we reduce our positions and reduce position sizing, and vice versa. Now, I've got all this with detailed explanation in one of the downloads that you're going to get access to later. So don't worry too much, but I want you to get the concept that what we're doing is we're using something else apart from just the stock chart that we're trading to determine whether you should be buying calls generally or buying puts generally. Because as we know, not all stocks go in the same direction as the index. We don't want to be trading against that. This is designed to help us and also help us decide how many we should buy in terms of managing our risk. And this is key to getting those figures that were talked about before. Skip through that. Okay, then the next just going to have a quick look at questions. Yeah, look, it's okay. One of the things I'm going to do is all of the slides are going to be on available as a download, along with extra information about everything that I'm talking about here. So just hang on, get the concepts. If you're slightly newer to the game, it's all okay. So contingency planning is the other thing that people don't do. And really what you need to have in place is something that says, it doesn't matter what goes wrong, I've got something in place. And this all comes from a time where I was unexpectedly admitted to hospital, hadn't got some things in place, and the market didn't do me any favours for a couple of days there while I was slightly spaced out. But it's not just physical, it's not just illness or anything like that. It can be mechanical, it can be physical, it can be psychological, and all of these should be planned for in terms of an action, either from you yourself or using a third party. So, for example, if your internet software goes down, what's your contingent? What do you do? How do you trade? If you're not well, what do you do in terms of the positions you've got open? What contingent or conditional orders do you put in place if you've got an impending hospitalisation coming up? Is there someone there who can give your broker a ring and say, look, make sure there's stops in there for everything? From a psychological point of view, there's times when you really shouldn't be focusing on trading, where there's other things that are more important in life. And really, you need to come to every trading decision in the best decision-making state possible. So if you don't or are not in the position to do that for whatever reason, be it concern about something else, some major stuff going on in life, then pull back from your trading. It's okay not to trade. So one of the things that I want you to do, if you haven't got a contingency plan, is develop one over the course of the next week. And again, there's something there that will help you do that in the free downloads. Okay. I'm going to spend a little bit more time talking about position sizing here. What position sizing is, for those of you who are less familiar, is a way to manage risk according to your personal tolerance. Some term is money management. So it answers the question of how many you should buy of a particular call option or put option to keep your risk within a tolerable limit for that particular trade. The reality is, rather, we all do this. We have to make a decision in terms of how many we're going to buy, and whether we have a formula to do that or not. We all do it. Now, just as a side issue, there are other position sizing issues, like the number of trades, maximum number of trades you should have open, and maximum exposure to a particular sector, which should be part of the position sizing part of your plan. But we're going to focus on the actual sort of how many contracts do I buy. And with options, it does create a little bit of a challenge, because we're not actually basing our entry or exit on the vehicle we're trading. We're basing it on the underlying stock. Okay, so that's the first thing. And secondly, and we know options don't move with stock one for one. And secondly, it's the price and structure of options. So there's a couple of interesting challenges that we have to account for. Now, the easy way to position size is one of these methods. So we can use the force or whatever supernatural power and just plant our flag in whatever, which unfortunately is what many people do, and unfortunately usually doesn't create a good risk management process. Second way is we can divide our capital up into chunks. So if we've got 30,000, we can divide up into $10,000 chunks to trade for each position, or 2,000 or 3,000, whatever it is for you. Or we can have a set number of shares or set number of contracts. So we're exposing ourselves to 2,000 shares, we're buying 20 contracts, whatever it is for you. So those are the easier ways to position size. A better way to position size, taking into account the underlying share movement and the options pricing issue, is this. I'm going to just whiz through all of these, because otherwise it's going to slow it all down. Whoops. Okay, I'll go through this now. There is a position sizing spreadsheet that you can download with instructions as part of the free downloads. Okay, so again, don't be worried about writing this down. It's all there for you. Okay. So what we've got to do is start with the amount of capital we're investing. So let's say we had 20,000 capital to invest. We decide that our maximum tolerable risk is 2.5% of our entire capital. We don't want to risk more than that on any one trade, which is $500 a trade. That's going to be a maximum risk. Now, some people would do 3%, even 4%, to give scope to reduce that position size should market conditions dictate. But let's start with this for now. Let's say the bought call premium was 75 cents. which is sort of irrelevant really, what we actually pay for the premium in terms of our position sizing. What's relevant is our underlying exit and our underlying entry and our underlying technical exit. Okay, so if our underlying entry on the share is $25, our underlying technical exit is $24. If it was stock we were trading, it would be a $1 difference between the entry and exit price. And these are always obviously predetermined. Because we're talking options, then we have something called delta, and this is how much the option price moves, the option value moves for 1 cent move in the underlying share. So if delta is 0.5, what that means is the option moves half a cent for every 1 cent in the share price. So if theoretically, if the share was to move $1, then that would be a 50-cent difference in the option value. And usually we find that at the money calls or at the money puts have a delta of 0.5. Here's a way to remember it. 0.5 is sort of in the middle, so it could go, it's got 50% chance it goes one way, 50% chance it goes the other. So that's a way to remember if you're not familiar with delta, that delta's 0.5 for an at the money call. So a $20 call when the stock is $20 would have a delta of 0.5. So what we would do is we'd take the stop loss level of $1 and we multiply by delta, and that would mean our risk, our option premium risk, is 50 cents a share or $50 a contract. If our maximum risk that we defined up here is $500, then that means we can buy 10 contracts to keep. So if our stop is triggered, then that's the loss. No more than that. And of course, we're going to trail stops and all that sort of stuff. So that's if it turns around and goes the other way the next day. So now I've got there's an easy spreadsheet that does all the calculations for you, but that's the way to do it with options with a single leg strategy. There's other ways to do it with spreads, etc. But there we go. That's the way to do it, to keep it within a tolerable limit. Now there's two caveats on position sizing. First of all, you've got to follow it through. There's none of this, oh, it's okay, it might bounce up tomorrow nonsense. If it triggers your stop, now you may choose to trigger your stop in your last hour. That's what I tend to do as a standard. I don't tend to do much trading outside that last hour. And of course gapping. But the major reason people don't do well with money management is the first one, not the second one. That's why my major interest is one of trading psychology, because you're not going to do well unless you get that sorted. Okay, so fairly whizzing through now. So what we've done so far is we've looked at a good set of results and what we measure to determine whether those or to make those results possible. And we've looked at key issues around that. So looking at the right things to measure, and of course position sizing. So now we're going to move on to exits, and really let's look at the difference between entry and exits. Let's move all these. Whoops. Just give a second for the view to come up. Okay, so the idea of entry, and this gets lost on a lot of people, the idea of entry is to increase the probability of a trading idea going in your desired direction. That's why we use the indicators we use. I'm not going to talk Hawkeye today. It's a fantastic bit of software, but that's another story for another day. But it doesn't matter what you're using, these are common principles, okay? So the entry aims to increase the probability of the trade going in your desired direction. Exits determine your real deal profit loss. It's not entries that determine your profit loss, it's exits. And unfortunately what happens is everybody's major focus is on entry. Entry indicators are the sexy thing, okay? And if people aren't successful, what do? They add another entry indicator. So they get very colourful 14 or 15 indicators on a chart to try and determine entry. When really, essentially, the problem is usually exit, okay? Remember that. Keep the loss small, let your profits run. Okay, if we keep every loss small, we can be wrong an awful lot of times and still make an awful lot of money. 252% in 8 months sort of money. Okay, so the reason we have to focus on exits, I'm not saying entries aren't important, but exits are more important, is we need them to determine profit, and we need them to minimize loss to within a tolerable limit alongside alongside the position size we've just discussed. So I hope that's clear. And one of the things I want you to do is look at your behavior, look at what you focus on, and how much of your energy and effort is focused on entry versus exit. If you think there's an imbalance there, then there's something possibly you can do about it. So let's look at the types of exits, and really as you develop your trading plan for this, and obviously we can talk through that with anybody who's interested, but really these are the things that must be in your trading plan if you're directionally trading options, so buying calls or buying puts. It's not enough to say that simply that your exit will be determined by a particular indicator. It's not enough, because there are different sorts of exits with options. So first of all, of course, we've got our profit taking exits, which are the ones we prefer. So we've got a trail stop, which many of you will be familiar with. Now, whatever you use, you should be trailing a stop immediately after entry, irrespective of direction. Okay. Secondly, when you tighten a stop, so there are situations where you may say, right, okay, normally, let's give a very simple example. So let's say that you use a 5 exponential moving average as a trail stop on a bought call. Okay, so as soon as the price moves below that 5 EMA, then you're out. Okay, a very simple system. Simple's often good. Okay, so let's say that was the way you trail the stop. There may be situations where you feel it's merited to tighten the stop. So situations such as perhaps you're nearing a previous resistance. Okay, it's called resistance for a reason. So the underlying stock price is moving up to resistance level. There's a fair chance it's going to bounce back downwards off that resistance level. If it breaks through, fantastic. If it doesn't, then we may well have tightened our stop to make sure that it doesn't drop significantly. It may be that we tighten the stop when a share price has moved up, has accelerated up pretty quickly. So we may trail from a 5 EMA to a 3 EMA because, quite simply, the distance between current price and 5 EMA or whatever you use as a trail stop is now significantly larger, which means you're going to give back quite a significant amount if your stock turns around and goes the other way and triggers an exit on your option. The third type of profit taking exit is a profit target. Excuse me. And of course, using the example we just used, it may be that your profit target is just under a previous resistance. So you enter a stock, maybe enter an options position when the stock is maybe 3 or 4% underneath the next resistance line up on a chart, and use that as your profit target. The fourth profit taking exit, and I put this in brackets simply because I don't do it, but there are many out there that subscribe to the idea of a staged exit. I don't, for the reason that an exit is an exit. If I've got an exit signal, then it's time to get out. Now, for those of you who do, one of the things I want you to do is look back test the result when you staged an exit. Was it a better result by staging an exit or otherwise? And it's easy to do because you've got all the figures. So please do that. It's important. Again, if you're trading as a business, you should be measuring every single detail of what you do. Our loss minimizing exits are twofold. Our initial stop, which is what we've already talked about and how we determine position sizing, etc. And our what I call an event stop. And again, these should be articulated in your trading plan. So an event stop in terms of an option would be, so let's say that we wouldn't enter a bought call trade with less than 6 weeks to expiry. Okay, so our duration be 6 to 3 months to expiry date. So we may say that if neither a profit nor a trail has been triggered with less than 3 weeks to go to expiry, we close out anyway before we lose all the time value. Okay, you've got to determine which is sort of right for you. Fundamental reasons. I actually closed 2 positions as soon as the tragic events, this week that happened with Malaysian Airlines flight. Saw that happen, closed 2 positions immediately. Other situations may be at the big data points. You've got non-farm payrolls every month. That's usually a market mover, so I have been known to close down or reduce positions before that. So that's what I mean by a fundamental event stop. And a personal event stop would be something that's happening in your world. It may be that you're going on holiday, maybe an event is coming up in your world that's predictable, that says, right, well look, I'm not going to be able to focus as much time on the markets. Maybe I shouldn't have 4 or 5 positions open. Maybe I should have just a couple. So you need to have all of these. This is your exit checklist. You need to have all of these written in your trading plan for your directional trading of options. Okay, I think I'm just going to check. Yeah, don't worry. Everything, all the slides are available. Always talking about options, John, but we use the underlying stock movement to determine entry or exit. A staged exit would be where you say, right, I'm going to exit half of this. I've got 20 contracts open. I'll take off 10 off the table now and leave 10 on the table. Yes, I think everything's been recorded. Karina, I think so, yeah. Okay, quickly answer those questions. Okay, nice little trick for those of you who are already in the market, already doing options. One of the things that I've used with some success is accumulating on an existing options position. Now what I mean by this is we've entered a position on a good signal, and the underlying has gone in our direction, so our option has increased in value, then and continues to look strong. It may break through another key level and really would be another buy signal if you weren't already in it. You accumulate on a position by simply buying more contracts. So it may be that we started off with 20 contracts and we bought another 20 contracts at a particular technical event. So that's what I mean by accumulating an option position. So these are the rules of the game, and again, part of the downloads that I've got for you to choose from if you want to is essentially how to integrate this into your plan. Okay, so these are the different components, just to give you an overview. Often these are pre-planned, so it may be that we've entered a low position size to start with, so there's something in the market that's amiss. That technically the chart looks strong, but because of the way the market is generally, we've perhaps entered half of the position that we would normally enter. So that may be one reason to accumulate. Remember, we only accumulate into winning positions. We don't average down our losses by adding to losing positions, because that's the jackass theory of investing success. And if we've pre-planned it, often we will buy an out of the money option. So say, for example, the underlying stock was at $32. We might enter a $33 call, or even a $34 call with slightly longer expiry, 3 or 4 month expiry, if we saw significant upside in the underlying stock. We'd actually predetermine at what price point, at what level we'd accumulate. So there's a number of different ways we can do this. One way that I've used with some success in the past is to accumulate a 2 times ATR above the entry point, or alternatively, as I've mentioned before, a break of an established key point at a higher level, so a previous pivot high or resistance. So if you predetermine these, then it, like anything, if you predetermine stuff, it just makes it a lot more smooth. You're making good judgments rather than using emotion primarily to make your decisions. A few rules of the game: you wouldn't accumulate if you had less than 6 weeks to expiry. You'd only accumulate 1 per 1 maximum, so that means if I'd entered originally 10 contracts, wouldn't enter more than 10 contracts. When I accumulated, may even enter less than 10. we would trail the stop up to break even on the initial position as a minimum. This means that the risk of the trade is no different from the original entry. Okay, this is many of you will have heard about the turtles. This is the sort of trick that they use to make lots of money. Is accumulating on positions as something moved up and trailed a stop to break even on the previous position. And obviously we recalculate our position based on the average of our two positions entered to work out where we were in terms of profit loss, although of course profit loss is not what you make your decisions on, which I'll talk about, might mention later if we've choices. How does unusual options activity affect your choices? Great question, Rita. What Rita's asking is sometimes you'll notice that there's a significant number of you'll see a spike in the number, perhaps the number of calls bought or the number of puts bought, which indicates that perhaps the market's feeling that something's going to occur in the future. Somebody's got an inside track on event or an announcement that may be made. I don't tend to use that. I did go through a stage maybe 3 or 4 years ago where I had a good look at it and really didn't find, although it worked and worked very well sometimes, if I went with that as a particular idea, sort of followed options volume, if you like, I didn't feel that it was robust enough to base a decision on, if you know what I mean. But I do know people who do it and swear by it, but it's not my thing because I couldn't find the evidence to suggest that it would benefit me at all. But great question, Rita. Great question. Okay, so whizzing on through, because I know we're coming up pretty close to time. We've got about 6 minutes left, I think. Yes, of course, you can have a copy of the slides. I'll tell you how to get those in a minute. Here's the 5 major mistakes that options traders make with alarming frequency that means they donate wallops of cash to the market. First of all is they don't measure their trading beyond looking at profit loss. It's all about decisions. If you're not journaling, if you haven't got a journaling system, email me please and I'll give you what to include in a journal. Look, you don't have to do it eternally ad infinitum, but if you do it for 2 or 3 months, see what it throws up and then put some actions in place to tighten up your game, and then maybe another 4 or 5 months later do another 2 or 3 months consecutively. But journaling your decisions are what it's all about. It's not about win-loss, it's not about profit loss. Those will take care of themselves, okay? You be the trader you can be, you do the right thing on a consistent basis, and the money follows, okay? That's the reality. And no matter how many people I've worked with over the years, that's their reality as well. It really is. You need more than one strategies. You'll have people who just do covered calls. Great strategy though that is. It's not going to cover all market situations and you're going to get hurt in some markets without. Likewise with directional trading, there's sometimes where you switch that off. And one of the key tactics, one of the key skills that you've got to learn as an option trader is to match strategy to market conditions. And I invested quite a lot of time in doing that with people that I work with, both on a formal and an informal basis. Most of my webinars will start with, most of the trading room webinars that I run will start with just where the market is and looking at, well, look what strategies are appropriate right now. As I said before, mistake is people focus their energies, efforts and time on entry when really exits are what determines how successful people are. They fail to recognize how risk changes during the life of a trade. What I mean by this is, here's an example. If you've set a profit target for where the underlying stock is $2 above, okay, and your maximum profit out of this trade is $1, okay, so let's say you paid $1 for the option. If it gets up to that resistance, that profit target, then your maximum return is going to be $2, so $1 profit, 100% return. Okay. If the underlying stock has gone up to, let's say, 10 cents below that resistance line, and your profit target is 10 cents above, okay, that's probably 5 cents option value. So at this stage you're risking $1.95 per share for a 5-cent gain. Does that make sense? Does that make sense that you should take that risk, or should you just rip it off the table and look for the next opportunity? So do some work. There's a couple of blog posts I did that about this, but look at how risk changes during the life of a trade. So every trade you should be saying, well, look, if my stop is triggered now today, what would be the result? And that's the same with the trail. If my profit target, if you've set one, is triggered, what would the result be too? So keep an eye on risk during the life of a trade, not just at the start. If you have 150% return profit and you let all that go back into the market, bar 20%, so you made 20% of the trade, not 150%, you've lost 130% of where you were. Okay, you've got to see those as losing trades. Okay, maybe that'll help you recognize how risk changes. And the other mistake that people make is they don't give themselves permission not to trade. Really, there's times when people shouldn't be trading. Just take your foot off the accelerator pedal. The markets will be still there tomorrow. And one bonus sixth, shortcut learning. You shortcut your learning, you'll get shortcut results. It's really as simple as that. Okay, so that's really what I had to say. I know I've whizzed through that quickly, but I've got all of these things that you can download. This is the hawkeyeoptions.com/options kit. We'll get you there. So there's more detail. There's a 3-pager on, I think it's a 3-pager on that trading direction using the SPY and the VIX for integrating within your trading plan. There's an Excel position sizing calculator with instructions, so you can do that position. Just plug all your numbers into the position sizing calculator and determine how many contracts you can buy. There's some information to integrate into your plan about accumulating to a winning position. There's an options health check, which is really going to be good for you guys who are new, and probably good for you guys who have experience to make sure that you haven't got any gaps. These are the things you need to know. So you complete the first sheet, and then on the second sheet it gives you the graphs, and you can prioritize from that. There's something that involves a little bit of interaction with me. One of the things that gets in the way of people are these inbuilt things called cognitive biases. If you want to download that, email me. I'll send you a 15-page report. There's a 21 Emotional Secrets of Professional Traders ebook. Emotionless trading is a myth. Don't kid yourself. Don't let anybody who tells you that you can trade without emotion is what I call a matchbox or a beer mat psychologist. All the no is written, you can write on the back of a beer mat. That'll help hopefully, and again there's a checklist within that says, well look, these are the things that you may want to work towards. It's about channeling emotions appropriately, not pretending they don't exist. The slides in this presentation, and I'm going to run a 3-webinar series called Mastering Options Trading, and you'll be invited along to that as well. Now, all of that will cost you no dollars at all. Okay, really, that's a thank you to the guys who invited me along to this. It's a pleasure and a privilege to talk to people like yourselves, and those of you who after that want to talk to me about anything that will involve you taking on some more learning or some more development, then by all means we can chat. But really, this is a thank you for being here. It's a gift, and I trust that you'll all find something useful from that sort of page where you can download all that from. Okay, so really that's me. I thank you for your attention, for your participation. The questions have been awesome. As I said, I'm going to scoot through the questions. I think I'm just about dead on time. I'll scoot through the questions at the end. Quick answer to you, John. Do options allow you to put in a trail and stop? Absolutely. You can. In most trading platforms, Option Express, and the guy, that's what I use, and the guy who previously presented uses Option Express, or at least was showing Options Express. You can put 2 types of trail stop in. I tend to use a contingent, what's called a contingent order based on the movement of the underlying stock. So it says if a price is less than X, then close the position down, close the options position down. So takes you a couple of minutes to learn, but that's that. I think that's all questions answered, guys. It's been a delight. You know where to get hold of me now. And good luck, trade safe, and take care of yourselves. Hey, enjoy the rest of the day and the rest of the weekend.